The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Caroline Hyde.
And I'm Bonnie Quinn, and we're kicking you off to the closing bell right here in the United States. And what a day. We had Fed Chair Jerome Powell speaking at Jackson Hole. So let's get a check on where markets are now, Caroline, as we approach the final couple of hours before the last week in August. The S&P 500 up more than 1.5%. As you can see, a monster rally after that speech. The Fed chair opening the door wider, in the words of Michael Feroli, to a September rate cut. The Nasdaq 100 up 1.6%. We're, bear in mind, only about 10 points off that S&P record. We might even get there by the end of the day. The two-year yield plummeting, down more than 10 basis points, and that's off its lows, 368.79. We saw that move across the curve, not so much in the 10-year and the 30-year, but plenty of buying in the 2-year. And the dollar, as you can imagine, much weaker, down 0.8%.
It is. Meanwhile, Bitcoin on the higher side. All of this, of course, funny, as the door is cautiously opened to a rate cut in just a few weeks' time. Look, during his annual speech at Jackson Hole Symposium, Federal Reserve Chair Jerome Powell signaled that the labor market, it's flashing signs. A cut could very well be on the table during the Fed's September meeting. Take a listen.
The stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
Look, as Vonnie told us, Wall Street was certainly a fan of the speech, selling bonds and stocks absolutely surging. The S&P 500 just on the cusp of a new record high following a 5-day slide. And look, we are actually seeing the Nasdaq higher on the week. Let's dig into the dollar. It slides. Risk assets like Bitcoin, as we see, they're moving higher. Futures traders also starting to price in that a September rate cut is almost a complete certainty. But look, while Powell's remarks come at a time of unprecedented pressure on the Fed from the White House, the administration, well, it's been making market waves of its own. Look, this afternoon, President Trump announced Intel has agreed to give the U.S. government a 10% equity stake in the chipmaker. The move marks a possible new policy stance. Commerce Secretary Howard Lutnick signaling this week that Trump wants to see maybe some more direct benefits to the U.S. from funding these sorts of key companies, Vonnie.
Giving Intel a little juice today. Mind you, there are not that many stocks that are lower today in general, Caroline, so we'll have to see how things trade at the end of August and into September. To that end, I just want to point to the market pricing of the Fed rate cuts by the end of the year. So we're getting into nitty-gritty at this point, but this was where we priced in a full rate cut in September. It was 100% priced in. Traders were certain it was going to happen. And then they dialed them back again as the data came in. Well, just in the last day, as you can see, we are again almost, so about 85 to 90% pricing in a full rate cut in September. So there is a tiny, tiny part of the door that is not open, if you like. But basically, traders are thinking that September is almost a done deal. And then you see this for October and this for December, because at this point, traders are moving on. Market participants are looking to see what's going to happen after September and just how many more cuts we're going to get. Or would we get a pause, Caroline?
That's a key question. Let's take it out to Bob Dole, CEO and CIO of Crossmark Global Investments. Look, take us to September, take us through the rest of the year. Is it a done deal?
I think September's a done deal. I think it became a done deal when we got the earlier this month employment report and that big revision for May and June, creating May, June, July is the worst job ads in 5 years. I think that sealed September. This Fed, as you know, is very data dependent, so let's watch the data and we'll know. I think there's a decent chance of December, but a lot can happen between that now and then, as you know, Caroline.
And what is thus for being priced in from your perspective, Bob? We've already seen a market reaction in anticipation. Is there any more juice to go? Well,
for September, not really. I think market participants, if they didn't prior to today, believe September, everybody's there now. So tell me what inflation's going to look like from now to the end of the year, what the employment numbers are. Look, the Fed chair was pretty clear. The risks have shifted in his mind, and they're going to be fighting rises in unemployment, let inflation be what it's going to be.
Yeah, the phrase he used, Bob, is that it's a curious kind of balance in the labour market. Both the supply side and the demand side are seeing softness. Just how concerned should we be about this labour market? Are we going to have a shocker of a report either next month or the month after?
Not out of the question, Vonnie. Look, as mentioned, the August report and the revisions were just horrible. Another report like that or two, and the Fed will be hard at lowering rates, and they'll have to be. Look, we know while the unemployment rate's not moved up, it signals that firings are not up a lot and hirings aren't either. So I think that tells us that businesses are very uncertain and going to wait and see which way to move.
He also outlined some other possibilities, including that wage dynamics could weaken and also including that inflation expectations could move up again. I mean, if all this happened together, it would be a very nasty perfect storm, wouldn't it?
It would, and the market is kind of between the rock and the hard place, as is the Fed. The market is assuming growth's going to be good, earnings are going to be just fine, and they have been so far. The market's also assuming inflation's not going to rise to any significant degree, and that tightrope is getting tougher to walk across.
Bob, take us to the inflationary outlook, because at the same time as the flood of news that comes out of Jackson Hole, we also hear that Canada's going to be pulling back on its countermeasures when it comes to tariffs. More broadly, what do you make of the tariff impact on inflation for the end consumer?
Look, I think that there's no question. Somebody's got to pay this tariff, and that will be higher prices. Now, we could debate, is that a one-time thing or is it going to last? But we know that the target for the Fed is 2%, and then we're no close to that. We're at a 3% inflation rate. Somebody says there's that much difference between 2 and 3, and I say it depends on your perspective. If you're a stock market investor, the fair PE differential between 2 and 3% inflation is about like 6 PE points. That's major.
Talking of fair or unfair PE, and indeed just valuations more broadly, Bob. Look, the Nasdaq's still down on the week. I'm looking at companies such as Palantir that, yes, rally on this day, but valuations are still extraordinary, to put a finer point on it, when you're thinking about at least 190 times it trades its future profit expectations, Bob. How much is too much enthusiasm around the AI trade, even at this point?
Well, look, AI so far is a real deal. We just don't know how fast it's going to come in, how much a difference it'll make. Let me answer it this way. When the PE on trailing earnings is 27 and on forward earnings is approaching 24, the world better be close to perfect. It may better have found something special, i.e. AI, and it better work. Otherwise, you can't justify the valuations. Valuation is not a timing tool, but it does give you a sense of risk reward.
And beyond those parts of the market, Bob, it seems like small caps and other sectors like autos have just been waiting for this announcement of a rate cut. Now, we're still not there. We have to get to September 17th, right? But the Russell is up 3.8% today on those hopes. And if you look at the autos index or the, housing index, for example, we're seeing nice gains there too. Can we assume that this bleeds into those parts of the economy and that at least we might see silver linings there?
I think it's to assume it as a little bit much. Should there be some logic to lower rates benefit small cap stocks, the consumer, other cyclicals? Yes. But they're not exactly cheap, as we pointed out a second ago. So watch the fundamentals carefully. They better be there.
Better be there. We're very glad that you were here with us. Bob Dole, CEO, CIO, Crossmark Global Investments. Happy weekend. Now, coming up, we'll continue the conversation on Powell and if a rate cut at the September Fed meeting is truly a certainty. David Kelly, Chief Global Strategist for JP Morgan Asset Management, joins us.
Plus, we'll also keep following the news on Intel and what a government stake in an American tech company could mean for the broader industry. We'll speak with Daniel Newman, CEO of Futurum.
And a broader discussion on policies coming out of Washington. What to expect next from the White House with James Lucier, founding partner at Capital Alpha Partners. All that and so much more coming up. This is The Close on Bloomberg. Defense unicorn Saronic making waves today, laying the keel, cementing the manufacturing process for a new autonomous maritime vessel. Look, it's set to be the startup's biggest autonomous vessel yet. It's a niche but growing segment of the defense market where Saronic has positioned itself on the cutting edge. I spoke with the Saronic CEO and co-founder, Dino Mavrookas, earlier. Here's part of the conversation from Louisiana.
Scale is what matters. When we started this company, the very fundamental principle that we started it with was if we can't build hundreds or thousands of whatever it is that we're building, then we're not going to build it in the first place. Let's talk a little bit about the discrepancy that we have with the Chinese. When we look at our primary adversary in the South Pacific, really in the world today, when we talk about not just militarily, but economically as well. What has happened in the United States in terms of shipbuilding and what has happened in China is completely bifurcated, right? You go back to World War II, we built 18,000 ships or over 18,000 ships at the peak Last year, we built 8 or 9 naval vessels, and we have a plan to retire 19 over the next 12 months. China, on the other hand, over the last 25 years, has invested so heavily in their shipbuilding industry. They went from 5% of global shipbuilding capacity to over 50%.
Right.
They delivered 972 commercial ships in 2023. The United States delivered 7.
So you want to go, what, to deliver 50 unmanned vessels, ships per year as it stands, just in this one Louisiana site?
That's correct. We're sitting in the Louisiana shipyard right now in Franklin, Louisiana. That is 100 acres. We're going to invest $500 million to $1 billion in this site alone. We're going to build up the entire 100 acres, and we're going to have the capacity to build 50 ships per year. We're going to rebuild the workforce, training, production facilities, everything that's needed to do that. And then on top of that, we're looking at a secondary site called Port Alpha that'll be 10 times larger than this site in Franklin. We're talking about 1,000 acres, a mile of coastline, a multi-billion-dollar investment over the next 5 to 10 years to rebuild the foundation of American shipbuilding and create what is literally going to be the most advanced shipyard anywhere in the world, all centered around maritime autonomy.
VCs, of what you used to actually be one, have rushed to get in to help with this manufacturing, but the government is also backing it. Has there been a change of pace under the new administration?
There has been, and I'll tell you, you mentioned earlier, I was in the SEAL teams for 11 years. My last 5 years were spent on SEAL Team 6. That was from 2004 to 2015. I say that to say this. This is the fastest that I've seen the military and the government move to adopt anything in my life. Now, that is extremely encouraging from a business and an operational perspective, but it should also be concerning when we think about why is that happening, right? The potential threat with China in the South Pacific. We need to move, and we need to move now. And that's why we're operating so quickly here at Saronic. We're investing private capital to build the technology that our warfighters need and get those solutions in their hands as fast as possible.
What else do you need, Dino? You talked about how you're building the infrastructure and the talent, but what is it that keeps you up at night, that stops and holds you back?
When we think about what we need, I break it down to talent, customer, capital. If you bring those 3 things together, there's magic that is happening here at Saronic. What I mean by that is we have a truly world-class team. Our co-founders come from phenomenal companies with phenomenal backgrounds. We have over 800 employees now across the country and actually across the world. We've opened locations in Australia and the UK as well. Capital, we have some of the world's largest and best investors, 8VC, Andreessen Horowitz, and the list goes on.
And you've got commercial customers as well. Just to round things out, how big a sector could that be in terms of demand?
I mean, we look at the commercial sector as absolutely critical. I mean, $100 billion plus commercial maritime market. And here's the thing that I point out to people when you're focusing on defense. It's you need a strong commercial industry to have a strong defense industry. We build all of our products for dual use, defense and commercial. What that lets us do is diversify our revenue base, invest more dollars into R&D to build better solutions for the government, build robust and reliable supply chains that can scale, take advantage of economies of scale. Like, you have to build for commercial use cases as well. The days of building one-off bespoke solutions for the government are just over. We need to be building ships by the hundreds and boats by the thousands. And that's what we're doing at Saronic.
And you've been able to make your supply chain work to fit that at the moment, because with tariffs coming in and a changing of the rules around metals and supplies, how has that been for you to navigate?
We spend a lot of time on supply chain. We have 24 people that focus on nothing but supply chain. But here's the beauty of what we've been able to do at Saronic. We're completely vertically integrated from start to finish. When I say we're building our own boats and ships, we're building our own boats and ships, right? We're contracting the aluminum and the fiberglass. We're bringing in every single component that is integrated onto our platforms. We're doing final assembly. And we have the capital and the team to bring things in-house when we find bottlenecks in that supply chain. That's very rare and very unique and a very, very strong differentiator when you talk about what it takes to actually get to scale.
Well, Saronic CEO and co-founder Dino Mavrookas there. And funny, what's so interesting, he says he's got the capital. They recently raised a Series C, $600 million. They got a $4 billion valuation. But when we think about valuations in the public market, think of how Palantir is up 100% this year. People are desperate to get into this defense narrative.
I was just going to say, he reminded me so much of the Alex Karp type narrative in the sense that you're talking about commercial and defense. The defense industrial complex is really changing in this country, isn't it?
It is, but what's so interesting, as Dino pointed it out, you had Palantir, you had SpaceX earlier on, then you had Anduril come. Now there is a whole spate of these new, really interesting, really exciting defense tech plays. VCs are desperate to put their capital to work. You've got Caffeinated Capital, General Catalyst, yes. Got A16Z and also 8VC, as we heard. But then so many more want to start backing. The government's also looking to spearhead this. I wonder how much the public markets are really trying to get behind some of these companies that will eventually IPO pretty soon, I think.
Yeah, it's fascinating to look at the website and their actual vessels, right? The Spyglass and the Cutlass and the Corsair.
They're cool. Yeah, they're cool. And they go from small, mini, almost jet size, ski size, all the way up to the 150-foot one.
Oof, well, I wouldn't mind being, in the driving seat, but I wouldn't want to be in
You don't have to be, it's autonomous.
No, that's true.
Now, coming up, we've got so much more to talk about in terms of tech, haven't we? Because, look, NVIDIA gaining. That's actually despite a potential crackdown on chips in Beijing. We're going to dig in there. We're going to dig into the Intel news as well with Gil Luria, DA Davidson. He's going to share his views on the company's earnings as well. Big on next week, NVIDIA Wednesday. Stay tuned. This is The Close on Bloomberg.
Time now for our top calls. A look at some of the big movers on the back of analyst recommendations. First up, Ulta. Barclays finding beauty in the makeup retailer, boosting its rating on the stock to overweight from equal weight and upping its price target to $589 from $518. Analysts are, quote, highly encouraged by positive changes from its new CEO and the promise of margin expansion. It also got a price target boost to $600 a share from JP Morgan. Shares, as you can see, up 2.25%.
Next in line, Paramount Skydance. Guggenheim stepping aside after the stock's significant rally, they say, since the recent merger, taking its rating down to a neutral from a buy and just removing its $13 price target. Now, analysts say it's showtime for the company's new leadership. Get this pun, but don't bet on further gains or until some key strategic questions are answered. Shares just flat on the day, Vonnie.
Don't BET on it.
Yeah.
And finally, Roblox. Wolf Research says it's game on for shares, raising its rating on the stock to outperform from peer performance, setting a $150 price target. Analysts cite so-called flywheel effects from the company's platform, including search improvements, and they note the advertising revenue potential is very nascent. Shares are up almost 3%, and those are some of our top goals.
Look, let's stick with tech, though, because Intel shares sharply higher after President Donald Trump confirmed the company agreed to give the United States a 10% equity stake. The president also suggesting that this won't be the only deal of its kind. This as juggernaut NVIDIA prepares to report earnings Wednesday after the bell. Let's do it all with DA Davidson's head of tech research, Gil Luria. Gil, let's just go to Intel first, because the precedent set here is kind of extraordinary. We're not in an economic crisis. We're not trying to bail out anything, but this is of national security. Your read on it?
That's right. I mean, we have to go. The comparable is more World War II, when we needed to nationalize our weapon manufacturing in order to be to make sure that the government has everything it needs. This is how we now see AI arms race with China. It is a matter of national security. We have the other pieces. NVIDIA, we'll talk about that in a second. They're doing great. American company, OpenAI, Anthropic, Google, doing great. They're doing their part to make the U.S. competitive in AI. We just can't make our own chips. We need Taiwanese companies and Korean companies to make our chips. That's like building a nuclear arsenal and having the shell casings made in another country that, by the way, is much closer to our adversary. That's why this is the unique situation where the government decided we need to be more involved with Intel. If Intel was able to do this by themselves, we wouldn't be interfering. But Intel's been fumbling and bumbling for years now. And we need to get this right. We need to be able to make chips in the United States.
Sure, Gil, but explain to me how the government helps. I mean, sure, it may be able to help somehow building factories in Cleveland, but what can it do to make us the world leader in chips?
It can lean on the scale. It can create incentives for Intel to make chips here. It's already been doing that. It can also make it harder for chip manufacturers from other countries to send chips into the US. We're doing that with tariffs. It can continue down that path. But another very important thing that's already starting to play out is that the government can bring other players to the table. Just 2 weeks ago, we were talking about the fact that Intel can't get its 14A manufacturing ramped up because they don't have customers. Since then, they've signed up SoftBank as an investor. That likely means ARM as a customer. The president has very direct dialogue with Jensen Huang. That can make NVIDIA a customer. We're going to put our finger on the scale to make sure Intel is successful.
I like that you take us to Jensen, because he's been busy talking in Taiwan as he's negotiating with TSMC on the next Rubin innovation for NVIDIA. But we've got earnings next week, and we've also got this report out of the information saying that maybe H20s are just being put on ice in terms of the supply chain right now. Give us your take, considering NVIDIA has responded saying that we're always assessing our supply chain and our needs.
China will continue to be the source of noise around NVIDIA's results. It's been the source of noise for Apple's results for years, and now that's what NVIDIA has to deal with. It's literally every day that we get a news story about whether or not we can sell the H20 into China, can't sell it, will there be a tax on it, will the government capture that? The drama will not stop anytime soon, because once we're done talking about that, we'll talk about, are they going to be able to make B30s? Are they be able to sell those? How degraded are those? It's going to add noise to NVIDIA, but we're all going to step back and say, there is a tremendous amount of AI demand right now. The models have gotten so competent, so useful to us, that as consumers and employees, we're using them more and more in our daily lives, creating all this inference demand, this compute demand. That's not changing. That's what's going to drive NVIDIA's results. China's just going to add noise. It's a very substantial part of their revenue, but they will continue to sell at least somewhat into China. And while their sales in China degrade, they'll probably be able to make that up in other places.
Gil, thank you so much. Much, much appreciated. That is D.A. Davidson's head of tech research, Gil Luria. In just another few days for those NVIDIA earnings due out next Wednesday. Well, coming up right here, right now, from rate cut hints to tariff hits. David Kelly of JP Morgan Asset Management joins us next for a wide-ranging conversation on what September holds for investors. This is The Close on Bloomberg.
Just about 3:30 p.m. in New York. A beautiful day. This is the countdown to the close, and Caroline Hyde.
And I'm Bonnie Quinn. Really something to watch the markets today. It's the end of August. You're expecting maybe not that much is going to happen, and suddenly we're at records again, Caroline.
Never try and fight what the Federal Reserve is up to in the balmy months of August, because they cause a stir, and it seems as though it's up and to the right.
It was a particularly odd day today, it being really Fed Chair Jay Powell's last Jackson Hole speech. So let's bring in David Kelly, Chief Global Strategist and Head of the Global Market Insights Strategy Team at JP Morgan Asset Management, to talk about it all, because again, we are going to hear from him obviously at FOMC meetings, assuming he's still in the leadership chair and he gets to chair those meetings. But as of today, are you suggesting that September is definitely baked in, and are you changing your mind at all about October or December?
Well, first of all, I think it's more likely than not that we'll get September. I mean, it's very likely. The only thing I would say is we do have another employment report. We've got another CPI report to come. So, you know, maybe we get 25 basis points, but maybe if the employment report is weak enough, maybe they put some pressure on them to give us 50 basis points. So, and I think also we don't even know in September whether we're going to get some dissents on both sides of this. So there's a lot. I think September is going to be one of the most interesting meetings we've had in years, just seeing where the Fed is.
And beyond the data that we get between now and then, which is some inflation data and a jobs report, we're also going to get way more before October and even way more before December. Yet you're pretty convinced at JP Morgan there's going to be 4 rate cuts this year.
No, well, I'm not quite for. No, of course, we may differ between us and the investment bank on this, but I think we get a rate cut in September. And then if you actually listen to what Jay Powell is saying, I don't think he even wants to cut in September. He really doesn't want to cut September and October and December. What he's saying, because if you think about what he's saying, look, we think our baseline forecast is that the tariff inflation is temporary. But when are you going to know that tariff inflation is temporary? You're not going to know that until next spring. And there's a lot more to the story than that. But if you're not going to get an answer to that, then you should move cautiously and slowly. And that doesn't mean 25 basis points every time you meet.
We seem to be putting far more focus on the labour market. So therefore, how much more focus do you give that August number and any changes to previous months.
There is more focus on the labour market, but as he said, we're in a very unusual situation because we've got a problem with labour supply as well as labour demand. They say that in the long run, full employment is 4.2%. Guess where we are today? 4.2%. We're at full employment. Meanwhile, they say that in the long run they want to have 2% inflation. And I think he's pretty convinced that by the end of the year, we're going to be at over 3% inflation. So actually, the inflation story is getting out of hand much more than the unemployment story so far.
I mean, the elephant in the room is the really unusual story is the political influence that is going on. And Lisa Cook's head now being called for in terms of seeing her leave the Federal Reserve. How do you navigate that at the moment in terms of just your forecasts and how you see the Fed going forward?
With great difficulty.
Yeah.
I mean, we have never in 113 years of the Federal Reserve seen so much pressure put by an administration so vocally on the members of the Federal Reserve, who I believe are honestly trying to do the best job they can. They do have their mandate is to try to get to maximum employment and keep inflation under control. And if you actually look at the story right now, there really isn't much justification for cutting rates at all. Inflation and unemployment are both where they want them right now, but they're both going to go up. And it's not the Fed's fault. I think Jay Powell and the rest of the Federal Reserve, I think they're doing. I don't always agree with them, but I think they are very honourable, and I think they're thoughtful, and I think they're trying to do the right thing. But they're under extraordinary pressure from the administration.
And he did give his base case today, but he also did give the other cases that it's possible that there will be lasting damage and that it can stick around, this inflation damage. He also talked about wage pressures potentially building, and he also talked about inflation expectations getting unmoored and so on. So there's a lot out there. What is your probability of recession, stagflation? What do you worry about most?
Well, I think that's a really interesting point because he didn't give two-sided risks to this inflation thing. He said all the risks seem to be on the upside, and I think that's honestly how he sees it. Right now, I think the economy is sort of. I've always thought it's sort of a healthy tortoise, and it will tend to plow forward slowly. And I think that's still what it's going to do. I don't quite see enough downward trajectory to cause a big spike in the unemployment rate. We could get, though this is one of the things that's going to happen between now and the meeting, we could get a weak jobs report, but we're also going to see a September 9th downward revision to all those payroll numbers for the last year. So it's going to look like job growth is really slow. The problem is labour supply is really slow too. So maybe this is all the economy can handle. But the other thing is, no, we don't quite see a recession this year. And one thing he didn't mention is we're going to have a refund bonanza in the first half of next year. And this is deliberately baked into the OBBBA. It was deliberately designed to push as much sugar into the consumer economy as possible in the first half of 2026. Now, that's something Powell hasn't even talked about, but that, I believe, will sustain inflation in the first half of the next year and actually prevent us from toppling over into recession.
Well, and certainly if the equity market keeps going the way it is, that's going to be an additional factor.
There's a wealth effect, and you can see this in the economy. I mean, it really is a K-shaped expansion. You can see a lot of problems with people paying bills day to day, and that's going to get much worse as this tariff inflation shows up because it hits the pocketbooks of lower middle-income consumers. But meanwhile, people at the top have made a fortune in the last 3 years in particular, but really going all the way back to 2019, we've seen a tremendous increase in equity wealth, and that is sustaining part of the economy. So I think there's enough demand to keep this economy going forward at a 1 to 2% pace. I don't think there's enough supply to do any more than that. So I don't see why the Fed's changing policy at all, to be honest here, except for that political pressure.
Well, let's go back to, therefore, the asset effect here.
Yeah.
Equities are near record highs on the S&P. The Nasdaq's had a bit of a brutal week as we question valuations. Do we continue to question the valuations going forward?
We should as investors, but recognize that, as many people have said over the years, markets can remain irrational longer than you can remain solvent. I mean, there are legitimate things to worry about in the equity market, but for as long as the narrative doesn't change a lot, people sort of just shrug their shoulders and put more money in, and that causes a momentum trade which pushes this equity market up. I mean, honestly, the fact that the Federal Reserve is sort of capitulating here shouldn't be a reason for the Dow to go up 900 points. Because, there's one thing that I think people are missing here. If the Fed cuts interest rates, you know how much it's going to stimulate the economy? Zero. Not at all. In fact, it may slow the economy down because people are going to say, what's the Fed so scared about? And by the way, if I'm going to borrow money, should I borrow it today or should I wait a few months? Well, I think I'll wait a few months, right? Because we never get just one rate cut. It's always going to be a lot. So why not just wait? It tends to drag on the modern economy. That's why the economy couldn't bounce out of the great financial crisis. Because rates were so low that it just discouraged people investing and borrowing now. So, be careful what you wish for if you're the administration. I think this actually slows the economy down.
A reality check. that we really needed going into this weekend. David Kelly, always great to have you here. Chief Global Strategist, he's head of the Global Market Insight Strategy team over at JP Morgan Asset Management. Really food for thought. Now coming up, shares for Workday, they are tumbling as the whole software sector really has been under pressure as of late. Today's stock of the hour, up next. This is the close on Bloomberg. Time now for our stock of the hour. Workday, one of the few companies that are on the downside at the moment in the S&P or indeed the Nasdaq. Shares you see off by 3.5%, let's call it. Investors, they were disappointed by the human resources software company and its subscription revenue guidance. It was unchanged in the latest report. Many want to see it up revised. Now, with the software sector seeing significant amount of pressure recently, I want to bring in Anurag Rana with Bloomberg Intelligence. So interesting, over in Europe, we've seen a real jitter in software, people worrying that generative AI was going to eat its lunch. What were we seeing out of Workday and others in the software space today?
See, I think that is a very big overhang on the entire sector, not just software, but consulting as well. But at the end of the day, I mean, the bottom line is you're not seeing seat growth, which is the companies where all these software companies are selling their software to, whether that's Workday with their HR software or Salesforce with the CRM software, those companies are not hiring at the pace that they were hiring. So, for a company that was growing, let's say for the sake of discussion, between 15 and 20%, that growth rate has come down. And frankly speaking, it has impacted lower end companies or companies that sell into the small and mid cap or the mid market more than it has somebody like a Workday, which is selling to enterprises. Frankly speaking, we thought the results were very good, 15% growth in backlog, but it seems, that wasn't good enough. They're probably looking at 100 basis points or so.
Yeah, what does it have above, say an Intuit or even an Adobe, Anurag? How can it maintain its moat?
See, Adobe is a very different animal because that's where a lot of the AI tools are generating some of the images. So there is an absolute, you could say, paranoia on the street about owning that stock. But when you look at somebody like an HR software like Workday, that's a system of record. That's where all of our, employment and all the, history goes in. I find it very difficult. A large company would just let an AI agent do that without, any checks and balances. So we are not in the camp that somebody like a Workday or CRM is going to be disrupted that easily. We have a similar view on Adobe as well, but Adobe has a lot more to prove on their side than some of these other vendors.
It's interesting, just Intuit had a similar issue today, just to reference another company that's on the downside in particular, because that's all about tax and that's all about efficiency there, but they too didn't live up to expectations. And a lot of these companies at valuations, not as much as in the hardware space, but have been priced to perfection a little bit more. People have been this week in general questioning valuations, Anurag. How much is that speaking to the revenue growth you need to see in earnings?
Frankly, if you see somebody like a Workday or a Salesforce, they've already seen a massive decline over the last 6 months. I mean, people have brought in valuations a lot. You had mentioned Adobe. I haven't seen that valuation ever in that particular stock. There was a time when it was trading, above Microsoft. So I think valuations are already there. The question is, what is the catalyst that moves the growth rate upwards? And perhaps, a rate cut could be it. I mean, if we see a subsequent rate cut, if we see the tariff-related uncertainty drop, maybe in 2026, we will see that seed growth everybody is looking for, and then a rebound in growth rates, and, that's when the sector recovers.
Huge competition for government and education as well, Anurag. Can it continue to make advances there and maybe quicken those up?
Yeah. See, one of the things is in certain areas, you don't have a replacement for somebody like a Workday. Workday is, north of 60% of Fortune 500 companies, which is you really are not seeing anybody else coming out and taking market share away from them. But at the same time, if you're already growing 15% and the customers are not hiring at that same pace, you're not going to see that user count or the seat count growth. I think they've already managed or executed very well compared to, some of the other companies. But at the same time, you see a slight hesitancy and the market's going to punish you.
Just give us a read on, therefore, the business desire to be putting more money to work in software more broadly. Zoom today having an actually lovely day because more people are seeing that the AI is giving them the productivity and willingness to spend more on that particular application. But we've been questioning all along this week of the MIT report and the fact that these AI pilots aren't working. What do you think, Anurag, about the willingness of service companies to spend right now in software?
So when you look at it, there is a complete bifurcation. If you have an exposure to AI infrastructure spending, if you are the likes of Microsoft, Oracle, or CoreWeave, you are seeing your fundamentals improve. Almost everybody else is seeing fundamentals decline because the non-AI tech spending has been under pressure since beginning of 2023. One of the stats we talk about a lot is, a company like Microsoft, over the last 3 years, they have increased their revenue 42%, but not so much the employee count.
All right, Anurag, Rana, thank you so much with Bloomberg Intelligence. Much appreciated. This is The Close on Bloomberg.
The market is kind of between the rock and the hard place, as is the Fed. The market is assuming growth's going to be good, earnings are going to be just fine, and they have been so far. The market's also assuming inflation's not going to rise to any significant degree, and that tightrope is getting tougher to walk across.
Bob Dole, CEO, CIO, Crossmark Global Investments, kicking off the show earlier. And now, as we head towards the close, less than 10 minutes, Fonny. Extraordinary that nearly every industry group is in the green, all apart from consumer staples on the day.
We are on record watch, and not just for the S&P 500, Caroline, but also for the Dow, would you believe? We're up 1.9+% on the Dow. The Russell 2000 up almost 4% at this point. The VIX just above 14. But if you see the dollar index, it is weakening and continuing to weaken. That 2-year yield as well, a massive move today, although we're off our lows there, just below 370.
And more broadly, you can see Bitcoin getting a nice push. Look, risk assets are pushing higher. Let's dig into which ones you should be exposed to right now and overweight. Kathy Entwistle's in the house, Managing Director and Private Wealth Advisor over at Morgan Stanley. And it's interesting, for once we've got a bit more breadth, let's call it, other than just 7 names that have led most of the market higher for however long. Is this the moment to start broadening out than just being the Mag 7?
We have definitely been talking about broadening out for a while now, and that those 7 stocks were, driving the indexes up and up and up. But there are opportunities in other names that have not participated in that high growth, and so stock selection is super important.
Well, we can discount Tesla because that doesn't almost count anymore. But it has been hardware, it's been chips. But now, is it the time for banks? Is it the time for the consumer, or is that a little bit too early?
I think in terms of the financials, they've had a nice run as well. The consumer is still a little worried about tariffs and how that's going to affect them, and they're being a little bit more cautious.
I mean, look at the Walmart numbers, look at the Target numbers.
Absolutely. So for us, we're looking at other things. We do think that technology area is still a plus, healthcare is a plus, and industrials even are a plus. It's areas where we might see those investments that are being made in companies that are either very global and the dollar is not, affecting them, or that they are working or building at home and not being affected by tariffs.
Fascinating. Well, it is the end of August. Liquidity is a little bit thinner than it normally would be, but is it a little concerning that just because we got the whiff that we're maybe more likely to get a September rate cut, that this market is flying? I mean, is it expecting many more rate cuts? Is this the beginning of a rate cutting cycle according to this market?
Yeah, I always say that what happens in the market is really a lot about perception and not necessarily about the numbers. And so you're getting that momentum buy right now where everybody wants to get in before something happens so that they get the upside to it. Because by the time these changes are made, if you wait too long, you miss those forward-moving numbers.
So what do you do about the Treasury portfolio in your portfolio? I mean, obviously you've missed out if you were a bull in some, parts of the year. Is it too late? Do you just throw in the towel now?
Well, I think that in terms of, we're looking at the more of a duration. So if you look at the short-term numbers, they've been very good for a very long time. But if you stay short for too much longer, whether it's treasuries or other types of investments, you're going to get punished for that. So if you've got money that really should be in the market or should be a longer-term investment, you have to start legging into longer duration. Intermediate is where we like best, and we do like investment-grade corporates. We like munis. There's a little concern about maybe some of the healthcare municipal bonds just because of some changes to support in that area. But generally, munis are still quite attractive. And for our higher net worth, higher tax-paying investors, it's a great way to get some yield. Stay
high net worth and not pay taxes. Yeah.
Exactly.
Oh, woe betide us and the high net worth individuals. I'm interested, though, about... We've spent this entire week actually worrying about valuations, worrying about the tech valuation space in particular, and some really retail-loved names. I think of the day that Palantir is having after what has been 7 days of absolute grind. What about the retail love names, and are they going to keep performing? Because we have seen froth in the market more broadly.
You know, retail has traditionally been challenged with tariffs and other areas of the market like we're in now. So I was a little concerned about going into this week with the retail numbers, and I think we've been seeing some of that come to fruition. It's all about, retail is all about the consumer, really. And if the consumer is going in and buying, then we're in good shape. But I still think they're being a little bit more cautious. They're shopping a little bit more on the sort of value side. And those areas should do better. And the areas that are a little bit, it's almost like a tale of two cities, right? Yeah. The lower end is going to do okay, and the very upper end will do well as well.
Let's talk about size. I mean, big caps have outperformed small caps. I mean, having a lovely day on the Russell 2000, but would you go into small caps more broadly?
Well, I do think it's important for clients to have a little bit of exposure to small caps and mid caps as well. And one of the reasons is because when we're coming out of a market cycle like we've been in, we can see some of those names start to show a little bit more growth. The issue with small caps is they're really getting hammered on a couple of different fronts, lending, and valuations and things like that. They just don't have the opportunities that larger caps do. Large caps have done very well, and we think they will continue to do well.
Earlier, the ex-Philly Fed President Patrick Harker was on Bloomberg Television. He was saying there's something a little bit off about this economy. It feels like it's in great shape in some ways, but yet there's something. And we heard it from the retailers, right? We know that all, not just low-end, but high-end consumers are shopping down. They're shopping in Walmart, they're shopping in Target, and so on. So why is that not being borne out in the data that we're seeing?
Because I think the data is usually based on past and not on future, right? So we get the expected earnings, of course, when they're talking about their numbers. But a lot of times that's peppered in, like a lot of optimism can be peppered in there. So I do think that the tariffs and all of the different changes that are going on will eventually play out unless rates get cut and now the companies are able to borrow at a lower price, and then there's ways to, fill up those earnings, and that's another way by reducing the bottom line.
Would you be rushing into things like home builders and automakers at this point?
I would not with my clients, no.
Yeah. So we're still way too early for that?
I think so, yes. I think basics right now and some of the things like software for technology, things like that should do better.
All right, Kathy,
thank you.
Thank you so much for coming in at the end of August and talking to us on this Jackson Hole Day in particular. That is Kathy Entwistle, Managing Director and Private Wealth Advisor with Morgan Stanley. And we are definitely keeping an eye on these market closes because we may just hit records, although it's looking a little less likely as we approach the close, Caroline. We're just off our highs at this point.
Maybe we take a bit of risk off the table as we head into a weekend and you think about where you want to be exposed in terms of stocks more broadly. NASDAQ still down on the week as well, actually. So after managing to get a bit of a rise higher on the optimism of a dovish tone from the Fed, still more broadly, we've questioned valuation in AI all week.
Absolutely. And, maybe these market participants are saying, look, we've got our profits from today. Let's just live to fight another day after Labor Day, after all, right? It's only one more week and then we have the Labor Day weekend as well, of course. But the VIX at just 14, I mean, really, you would look at this market and think, oh, it's fine. There's no reason to panic. And yet when we saw the tech sell-off, it started to maybe look a little panicky.
Panicky, but then you look that Palantir is still the best performing stock over the course of the year. We're still up 100%.
Yeah, absolutely. All right, well, do continue to stay with us. Closing bell coverage coming up right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Bonnie Quinn and Carolyn Hyde, and here to help take us through the closing bell, a global simulcast. We're joined also by Tim Stennebeck and Nora Melinda in for Carol Masser, bringing together our Bloomberg Television, radio and YouTube audiences worldwide to parse through the most crucial moments of the trading day. And what a trading day it was, team. Incredible, right?
Yeah, I mean, I think if we're talking about crucial moments, there was one moment, and that was Fed Chair Jay Powell's speech. And since then, we've seen stocks firmly in the green. A lot of people obviously focused on the major indices, the tech stocks and the S&P 500, but it's the Russell 2000 that is the real outlier today. Really, since around 11 o'clock, when it seems like traders fully digested those comments from the Fed chair, it's been firmly hovering just around 4% higher today, Nora.
Absolutely. I mean, we were just chatting about how there's so much that's really happened this week, but it's been such a flurry here on this Friday. crazy to think that we were even talking about earnings earlier in the week, but all eyes are really on dissecting what we heard from Powell earlier today, especially as it relates to the dual mandate and what that looks like for the Federal Reserve and what they can do about the economy moving forward.
Well, at the moment, stocks near all-time highs. We questioned all of the week running into Powell. Valuations, particularly on the generative AI front, particularly on the Palantir front, for once, they actually catch a bit of a bid. For me, one of the most key moments of the day as well was Intel. We finally get that focus that we are going to have a 10% stake by the United States government. That would be extraordinary news on any other day if it hadn't been Jackson Hole Day.
And don't forget, Canada taking off some of those USMCA goods tariffs as well. There's so much going on today, and we'll see, what else gets resolved through next week. All right, we are going to wait for these closing bells. Everybody very happy at the exchanges because we were finishing in the green. Let's take a look at those numbers as we wrap up this trading day. All right, we have the Dow Jones Industrial Average just so close to a record, which we haven't seen since December, but up 1.9%, 846 points there at 45,631. The S&P 500 up 1.5%, so well off its highs of the day, but nevertheless a nice gain to end the week at 64.66. And the Nasdaq, of course, up 1.9%. Those techs just continue to fly again, Tim.
You say broad-based on a day like today, and then there's broad-based. This is a day that is broad-based. 428 stocks in the S&P 500 moved to the upside today. Only 75 in the S&P 500 moved lower.
Let's just check in on industry groups and more broadly what we've seen across the board because, just consumer staples in the red. Everything else is in the green for once we have breadth. But look, IT, technology still on for a good run, 1.3%. The Nasdaq is still down on the week, but we're up on the day. Energy up 2%. Industrials, it really feels as though that's the air that gets powered by the hint of rate cuts.
Look at all that green on the screen. Scarlet Fu would call that a spinach pizza pie. I feel bad for whoever had to do decliners today. That would be Nora Melinda. Nora, thanks for doing
You left me with the
hard work. I did. I'm sorry about that. Hey, look at the KBW Bank Index, up 3.2%. Interest rate sensitive stocks surging today. This is the highest close, first record, going all the way back to 2022. First record for the KBW Bank Index, up 3.2% going back to 2022. All because of what we heard from Jay Powell. Traders happy that he signaled a willingness to cut rates next month, pointing to rising risks for the labor market, even as worries over inflation remain. Also, Caroline, you mentioned Intel. This was certainly on my radar today for a gainer. Intel shares absolutely surging on the day. This after we learned that the president said that Intel had agreed to give the U.S. government a 10% equity stake in the company. The president casting the agreement as one that would revitalize Intel, saying the company would, quote, has been left behind compared to competitors in the chip-making industry. Intel shares were up as much as 6% earlier in the session, and today up by 5.6%. Also on the day today, Apple shares hitting session highs. This after Bloomberg's Mark Gurman reported exclusively that Apple's in early discussions about using Google Gemini to power a revamped version of Siri's voice assistant. It's a key potential step toward outsourcing more of its AI technology. Talk about strange bedfellows. I mean,
it's a world of frenemies, Tim. It's a world of frenemies.
Can you believe that? I emailed Mark Gurman. It reminds me of that moment, Caroline, like 10 years ago when there was a demo. I think it was an iPad or an iPhone demo, and they invited Microsoft to come on the stage to... And everyone was like, what are you... This is Apple and Microsoft? These are two companies that have been arch rivals
who pays
for so many
billions
years.
To Apple all the time to be able to be the #1 search destination on their phones. That's the one that's been quibbled with by the government thus far.
There it is. Frenemies, I think, is the best way to describe that. All right, Nora, you have the hard job. Take it away.
Here we go. So let's take a look at some of the decliners that we saw today. I'm going to start out with the biggest decliner in the S&P 500 today, and that was Intuit. This has really been a stock that has been in focus after the tax software company delivered a tepid forecast, and this completely overshadowed an otherwise strong fourth quarter report. But we do have some commentary out from Morgan Stanley, the analysts over there, saying that given solid progress on core growth initiatives and a history of conservative guides, they would be a buyer on weakness here. But of course, we did see that the stock still ended lower today, down about 5.1% for this $185 billion company. Shares are up about 5.4% year to date. Let's move over to Workday shares. This is a company that's also been in focus. Investors were left disappointed that the HR software company left its subscription revenue guidance unchanged, completely flat here. Apart from a small boost that they did have from the Paradox acquisition, analysts on Wall Street are really flagging concerns around AI displacement continuing to linger here. Barclays is saying that the quarter was solid and the slight beats on a couple things like subscription revenue alongside with meaningful outperformance on profitability and cash flow would usually warrant a positive response here. But of course, we know this is one of the decliners. So here in the red on this Friday afternoon, shares of Workday are down about 14% so far this year. And lastly, let's take a look at SX, of keeping an eye on a lot of those rail stocks here. I'm looking at S15 rail. That index is down just a touch, down 0.3% today. But this is after we did hear that CSX and BNSF announced a new intermodal service products to ship between the Western and Eastern U.S. A lot of people were really looking for some sort of M&A here in the space for the railroad industry, but we're just seeing a partnership here. So you are seeing that reflected in terms of Wall Street sentiment here for this stock.
Some lonely sliders there today. Well, you know what else was down, guys? Yields were down. Look at that. It looks green, but actually that is the buying of treasuries, the dropping of yields. And that 10-year dropped like a stone after the Fed chair's speech was released. Down more than 10 basis points to finish the day at 369. Across the curve, you could see there was lower, but obviously towards the back end, not the huge moves that we saw at the front end. In fact, the 30-year yield there finishing the session at 487.76. And that 10-year glued to the 425 mark, 425.37. But I do want to point out one thing. Anna Wong from Bloomberg Economics is out with a note suggesting that perhaps markets are being a little bit too sanguine here, that the speech was actually peppered with hawkishness, in her words. She's saying he talked a lot about labour market cooling. He didn't signal the need for urgent action. So maybe watch the space. Maybe we've all sort of written off September as a month where the rate cycle starts, the rate cutting cycle, and maybe in the end it doesn't happen, which would make for a big reversal, I imagine. Yeah, actually, Nora brought this up on our program earlier. Is it going to be, if there is a cut in September, is it going to be a hawkish cut or a dovish cut? And yeah, I guess we'll have to wait and see. And there's plenty for us to sort of digest between now and then on a lot of data that comes between now and then that could change the narrative and change the picture. It's back to school time, everybody. So make sure to go get the backpack and
the pencils,
pack up for the dorm rooms because it's time to drop the kids off at college or wherever they're going. What we're learning now about this year in university is it's quite a bit different than previous years as a result of the pressure that some of these universities are feeling for a few different reasons. One, over the finances that have been hit as a result of federal grants that have gone away, but also the question about who's coming from around the world to universities that are traditionally filled with students from many different countries as a result of the way they've grown in recent years. That's a big question given the pressure that the Trump administration has put on these universities and also immigration changes. Now some of these colleges, Nora, are actually tapping their wait lists to fill spots before classes even begin.
Absolutely. It's a really interesting way that they're really trying to grapple with a lot of these financial pressures. Some of the top universities that we're discussing here, Stanford University, Duke, they're sending acceptances to waitlisted students just weeks before. Of course, we know a lot of these students are going to be trickling into the classrooms here. So an interesting creative pivot, if you will, as to what to do here in terms of the financial landscape. Not just sending acceptance letters all of a sudden, but also a little money oftentimes to sweeten the deal or to pay them back if they've already given some money to another college, or also emotional reasons, apparently. You know, you can get emotionally attached to the college you're going to. So.
Well, talking of sending money and creative pivots, the weekend. It is the weekend upon us. And can we talk about The Weeknd, the artist? $1 billion in financing backed by his music rights. That's apparently what's being negotiated at the moment. Lyric Capital Group going out there saying, look, maybe we could, with your using collateral of your music rights, of your master records, $500 million in senior debt, $250 million in junior debt, maybe a little bit of $250 million in equity. So interesting. Taylor Swift is buying back all of these things. He's busy trying to perhaps use it as collateral. I want to know what he's going to spend it on.
That's sort of like my question is. Like, does he need the money?
Is he going to make another Idol with Sam Levinson?
I'm just so curious when he's going to go by, because I mean, he's switching his name to Abel, right? That's his actual name. He's not going to be called The Weeknd anymore. So I'm curious when this is going to come into play here.
But I was fascinated because if you look at other artists that have sold their catalogs, like Bruce Springsteen, 550 million, Bob Dylan, 300 million, 1 billion for the weekend, but he is the most streamed artist on Spotify. Wow. In fact, he's 25 songs with 1 billion streams, and that's at least 7 or 8 more than Drake and Taylor Swift.
He's shaking up Atlanta right now. He's out on the road. He's doing his thing. Go listen.
All right, we got to run. Go listen to The Weekend. Enjoy all of your weekends. That is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We'll see you on Monday, same time, same place.
Coming up, a look at all the market action this week and what to expect next week. During the last week of August, we'll have Nancy Tengler with us, CEO and CIO at Laffer Tengler Investments. Do stay with us. A lot to parse. The Dow hitting a record today, the VIX at its low of the year. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Vonnie Quinn. Let's take a look at where markets closed out the day and the week, particularly this Jackson Hole week. We were so close to a record on the S&P 500, having had all of those days of declines, up 1.5%, well off the highs of the day, finishing at 64.66. Guess what index did hit a record, though? That was the Dow. Matt Miller is going to be very, very happy about that. The Nasdaq 100 also up more than 1.5%, erasing its declines for the week. Plenty of movement in the Mag 7. They had a very, very happy day. Yields plummeting, particularly the front end, as markets decide, look, it's a done deal. September is pretty much a 25 basis point cut. But there are a few voices out there saying, hang on a second, hold your horses. May not be fully the case. Bitcoin, another risk-on asset, up 4% again today, back close to $117,000, which it did top just a little while ago. So as you can see, all the risk assets and pretty much everything was higher today, except for the VIX. The VIX was at its low of the year. Now, I want to talk about some of the indexes that did particularly well, and that would be, as you might imagine, with lower rates, the home building index up 5%, although we have had guests on the show saying, no, it's not time yet. It's going to take a while for lower interest rates, if they even come in September, to work their way through the economy. But as you might imagine, automobiles also seeing a nice bounce today on the idea that perhaps lower interest rates will have people go out and maybe, kick the tires around again. Obviously, the semiconductor index played a big role in today's rally. There were no members of that index that were lower, and the whole index is up 2.7%. And as you might imagine, the one loser was consumer staples, down about 1/3 of 1%. But, that could be a very important indicator because there's lots of froth in this market in lots of places, as we've been continuing to hear. And maybe those consumer staples being in the red is a little lesson for us. Well, our top story this hour, Powell opening the door a little wider to a September rate cut. The Fed chair unleashing the biggest cross-asset surge since April, driving stocks and bonds sharply higher at the end of a very volatile week. The S&P 500 rebounding from a 5-day slide and now back near its record high. Joining us is Nancy Tengler, CEO and CIO at Laffer Tengler Investments. Nancy, great to have you. I was reading Matt Maley a little earlier on. He's always great on these markets. And he pointed to the fact that the Fed chair did mention, growth is slowing. And we know that, right? We're looking at a 1.2% rate at the moment. And that could be a warning for companies. Do you anticipate that once we get past the end of this earnings cycle, that we should start to worry about the next earnings cycle?
Bonnie, it's so good to see you, and thank you so much for having me. I just learned about weekend, so I've been. Thanks for educating me on that. Listen. I think earnings were pretty remarkable, and we heard a lot from our companies that they were raising guidance. Their margins were not getting crushed like we all expected, and I think part of that is what we've been talking about now for almost 4 years, which is this analogy to the 1990s when we had higher interest rates, higher inflation, but we had a productivity-driven economic growth. And that is where I think we are today. So will we get some pullback in earnings? I mean, we've seen it. Retail had some problems. Some of the staples certainly had problems, and they were like relief rallies after not not as bad as we thought earnings. But I do think you continue to own the names that are driving this new fourth industrial revolution and the old economy companies that are adapting to it. And so our poster child of that has been Walmart. And we think you want to own those kind of names that are embracing all of the new technologies to drive margins and earnings.
So then what did you think of Doug McMillion's comments that tariffs are seeping through week by week and that will continue to be the case right through the end of the year?
Yeah, and listen, I think a weak dollar is also a problem because we're importing inflation. So I guess I would say this. One of the offsets to tariffs that no one is talking about is the benefits to corporations, and particularly the larger end corporations, from the One Big Beautiful Bill Act. And that is 100% bonus depreciation, upfront expensing, deductibility of interest expense, and R&D credits. So those things are adding about $158 billion, closer to maybe almost 200, to cash savings in S&P 500 companies. The majority of that, or a big chunk of it, 38%, is going to the hyperscalers because they are investing, and those are going to be powerful offsets. Add to that, we haven't even factored in the benefits of deregulation because it's hard to quantify. I think that we're going to continue to sail through pretty nicely certainly for the second half of the year, and we think well into 2026.
What do you make of the idea, though, that there are all sorts of risks out there that we don't even know about yet, in terms of even the ones that are half on our radar, like more tariffs coming, or, you know, the possibility of deteriorating relations with India, for example, or other chip companies, or the president deciding he's going to take stakes in more companies? I mean, there's lots to be concerned about, Nancy, right? Would you take any money off the table here?
Well, I am concerned about some of these things, Bonnie. I hate the idea of the government picking companies and getting involved. The export tax, another thing that I think is a super bad precedent. But what we did this year was in July, we were trimming our winners, and this has been the case almost every summer for the last 3 years. So we were trimming the winners and then broadening out our exposure. And then this week we added on the real big sell-off, we added to names like Palantir in the 145 range and CrowdStrike, because we want to own those names, but we're not willing to say that it's time to take money off the table. The market's always climbing, a wall of worry. There are things I hate. But does the market care? Not so much yet, I don't think.
Really briefly, Nancy, I do have to ask you, if Palantir were to if suddenly, in a week or two's time, it's trading at $70, could you say you were surprised?
Yes. Yeah, I mean, I think, but remember this, Bonnie, last year we were buying, for example, NVIDIA at $88 a share this last summer. So these things are pretty volatile. The question is, what's the long-term trend? And our original position in Palantir is much below the current level, but we wanted to add and we got an opportunity. I wouldn't be surprised, though, if we saw some of these companies have major sell-offs in the coming months, but I don't think it's permanent.
All right, Nancy, thank you so much. Nancy Tengler, CEO and CIO at Laffer Tengler Investments. This is Bloomberg. Tonight at 6 p.m. Eastern, catch an all-new episode of Wall Street Week with David Weston. Our very own Scarlett Fu took a trip down to Dallas, Texas, a financial hub that hopes to take on Wall Street. Take a listen to part of that conversation.
Dallas really is a place where the American dream is still very much alive and well, and it's not rhetoric. Like, we really are a place where people can come who are not from here. We welcome outsiders. It's a place that really embraces energy and hard work, that can-do spirit we have. When we see it in other folks, we embrace it.
How long will it take for Dallas to win as a financial center?
I think we're winning. I really think we're winning now with the growth. There are still people that have not been to Texas that might have kind of an image in their head. So I think that over the next 10 years, as more people understand the sophistication, I think that image of Texas will continue to change.
Well, we go from Dallas now to Jackson Hole, Wyoming, where the Fed's annual symposium is wrapping up, but at least the Fed chair's day in the spotlight. So the spotlight lingering on Teton County, a place where billionaires are edging out the millionaires. Bloomberg's Michael Mckee sat down with a town council member and a rodeo owner to discuss the economic rise of the area.
The geographic isolation still really affects who we are, our ecosystem, our community, our sense of who we are, but it has much less effect on our economy. So now we have people from around the world who come and live here part-time, full-time. They work from anywhere. So we've really become a hub of remote work.
For decades, it was New York County, which is primarily the island of Manhattan, that led the country in wealth accumulation. But in the early 2000s, Teton County jumped into the lead. That trend has rapidly accelerated in recent years, and New York has tumbled into fourth place since the pandemic. Today, the average per capita income in Teton County is about $500,000 a year.
It was a small town. Everybody knew everybody here in this town at one time. It was extremely Western.
Philip Wilson is the great-grandson of Sylvester Wilson, who was the first settler to bring his family to the valley in the late 1800s. For Philip Wilson, his family, and so many of the other residents, the cowboy culture is not just for show. They were born into it. But he also says it's no wonder that culture appeals to outsiders and newcomers.
That's what draws people to Jackson Hole. The people that are here are friendly type people. They're outgoing, they're friendly. That's the only way they know how to be, because that's the way they run their lives.
And you can catch more of Wall Street Week tonight at 6 p.m. Eastern right here on Bloomberg. Sticking with Jackson Hole, Fed Chair Jerome Powell carefully opening the door to a cut in September. Take a listen.
The baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Our policy rate is restrictive, modestly so in my view. The stability of the unemployment rate and other labor market measures allows us to proceed carefully. While the labor market appears to be in balance, it is a curious kind of balance. Longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored. We will not allow a one-time increase in the price level to become an ongoing inflation problem.
Joining us now is Bloomberg's Michael Mckee live from Wyoming. Michael, markets all day took this as read that this was going to be a September rate cut. We were kicking off the rate cutting cycle. We do have Bloomberg Economics coming out, though, and saying, look, take a step back. There was plenty of hawkishness in that statement. There was talk of growth. There was talk of fragility of this curious labour market and so on. Is the market getting ahead of itself here?
Well, you can argue that the market gets ahead of itself in the particular levels it reaches on any one day, particularly on a day when it's reacting to news as it did today. But it's a little harder to say that the Fed doesn't mean it, because Jay Powell and his staff are smart enough to know that the language he used was giving permission for Wall Street to behave that way, to believe that the Fed is going to cut rates. Now, if we got a really, really strong payrolls report, a reversion to the mean on payrolls on September 5th, that could change the Fed's calculation. If we got a strong increase in inflation in the CPI report, that could also change their inclination. But for right now, it appears their forecast is we're going to get a moderate to weak employment report, and we will still see some inflation in from tariffs in the CPI report, but it won't be that much yet because it'll take time to get into the inflation numbers, and so therefore they could justify cutting rates.
Michael, 4 big central bank heads there, plenty more I imagine as well. What is your sense of how people are thinking about the global economy? Are they generally more concerned about labour forces and the health of consumers worldwide, or are they generally more concerned about inflation?
Well, it depends on the country you're in. Europe has 2% inflation. They're at their target. The British have much more inflation than we do. And, of course, we're in the middle there. So it varies country by country, and the impact varies country by country depending on what you're tariffing your own people on. Remember, the tariffs are taxes on the people who live in the country that's imposing them. And so what we're getting is a stronger dollar because more dollars have to come in to pay for the tariffs. Other countries are seeing an outflow of dollars, or they don't need as much. And so in their case, they're seeing weaker currencies. Yes. So it, depending on which country you're in, the central bank has different options.
Michael, thank you so much. Looking forward to hearing more of the chatter next week and beyond. I do want to point out that President Trump has said in the last few minutes he's going to do major tariff investigation on furniture coming into the United States. And these stocks, Wayfair and RH, trading lower off the back of that. Call it the melding of the Mag 7. Some crossover among the market's biggest companies this week as the AI story goes from unmoored to undeniable. You saw Meta inking a $10 billion deal with Google Cloud and poaching an Apple AI executive. Now, Apple is exploring using Google's Gemini AI to bolster Siri. Let's get to Bloomberg's Mark Gurman, managing editor of Consumer Tech. So if this all turns out to be true and it happens quickly, I know many Siri users that will be very pleased, Mark. I imagine that we're looking at sort of dates and months when this might happen.
Yeah, so Apple's holding what they call a bake-off internally, where they're trying to determine what's the best direction for the future of Siri. Right now, Siri runs on what they call Apple Foundation models. In other words, underlying technology developed by Apple. Right? We know from experience that in use, it's not always very good or as powerful as the competition. And so they're looking at what would it look like if Siri, instead of being powered by Apple technology, was powered by outside technology. And so they have begun talking in recent weeks with Google about the prospect of using Gemini models to power Siri. Previously, they've held very similar discussions with Anthropic. They got pretty deep with them, and to OpenAI to a lesser extent. So right now, basically trying to determine whether they should work with OpenAI, Anthropic, or Gemini, or stick to the status quo, which is their in-house model technology.
Is it going to be a cost decision or an efficiency decision?
It's a mix of everything. Anthropic, I'm told, in the talks with Apple have set a pretty high bar for pricing. OpenAI, obviously, are going public in a couple of years, so they want to hold a very high bar on pricing as well. Gemini, they have an existing relationship with Apple in terms of the parent company, Google, their larger $20 billion or so a year search deal that could be upended by the Department of Justice any week now. So there's certainly a lot of factors at play. I think, if you ask me personally, that 99% of consumers don't know or don't care who's powering the AI technology on their devices. They just want Siri to work. So I think at the end of the day, Apple's going to do what's best for the customer, but we shall see.
Yeah, I mean, it really always is the case, isn't it? You just want your devices to work. Mark, thank you so much. That is Bloomberg's Mark Gurman. Pivoting to another tech giant hitting the headlines, Intel. President Trump confirming the company agreed to give the United States a 10% stake and hinting it may not be the only deal of its kind. Shares of Intel ended the day pretty sharply higher even than some of the other tech companies that were rallying. For more and how this could impact the rest of tech, let's bring in Futurum CEO Dan Newman. Stan, maybe an unusual arrangement. It might help Intel build some factories. What else can the US do for Intel, the chipmaker?
I don't know that the U.S. needs to do anything else. I think it's this signaling to the market that it understands the importance that the United States has its own U.S.-owned chip champion that can manufacture the same type of chips that TSMC makes. And this isn't because TSMC isn't a great partner or that the relationship isn't tremendous or that their technology isn't the best, because it is. And we could easily continue our dependence on TSMC. But the challenge is, as we know, there's continuous conflict between China and Taiwan. The US being entirely dependent on TSMC for all the chips for NVIDIA, for Apple, for AMD and other companies is not a great strategy going forward. And Intel has not on its own been able to buoy its foundry strategy. And part of it's been being able to build the trust of those companies I mentioned to use Intel. And I think the U.S. getting behind it is going to accelerate that, even if it did mean putting their feet on the scale.
It's a bit odd all the same, Dan, right? I mean, a lot of those things the government could do without taking an actual ownership stake in a company. I mean, it reminds me of the GSEs in some way. And look, we're 17 years later and the government still, is right there in the GSEs. Is that going to happen to Intel? And also, what does it do to the existing shareholder base?
I think there's a lot to be seen there. As a taxpayer, I can get behind the idea of a passive investment, meaning, non-voting shares, which is what I've heard. And the idea that if the investment, just like Taiwan did in TSMC in its early days, by the way, does end up being very successful, that the taxpayers that are funding, because what they're talking about is taking the grant money from the CHIPS Act, which was going to be given with a few strings, but with no direct intention to pay back. At least if this ends up being successful, the U.S. is able to make its own chips and Intel is able to return to prosperity, either as part of the entire Intel or as a spin-off, which could still happen. there is a chance of either repayment or that investment gaining value over time? Because right now we were throwing money at Intel and Micron.
Dan, sorry, I do need to interrupt one more time because I still don't understand the rationale behind it. I mean, if the government really wants the US to be the best chip maker in the world, shouldn't it allow talent, no matter where from, to come in and, you know, be the best chip maker? How can it help a company that is not there? It's obviously not competing at the top of its game. It needs more talent. What else can the government do?
Well, the government can do a number of things. It could potentially try to form, you know, a JV. So we've heard that potentially they do entice TSMC into partnering, potentially by helping drive some of the largest chip makers, including NVIDIA and AMD, to build their chips with Intel. There could be some collaboration that could help develop the talent. Intel does have a lot of talent, though. There's a bit of a misnomer there. There's been some mismanagement. And right now, it needs to actually anchor its talent. And yes, there needs to be policy that helps bring more of the best talent to the US and helps them decide to work for Intel. But us deciding to let TSMC be the only provider has put us in a difficult situation. And if we want the next generation, because they do not bring their intellectual property here. So if something was to happen and China and Taiwan had a conflict and Taiwan was at war or there was a significant conflict that arose, we wouldn't be able to move to the next node. We would fall behind the world because TSMC is not building their most advanced chips here, even with the most recent announcements of their 2-nanometer coming to Arizona.
Yeah, and I know Intel is a particular example. It's been in the doldrums. It's had a lot of trouble. But you do wonder, what is the bar now for the US deciding it wants a stake? And will, you know, is it if a company is not trading at a multiple the US thinks is the right multiple? Is it share price? You know, you have to wonder, is something like NVIDIA next, for example? Okay, sure, it's doing well, but, you know, when will the US government decide it's not doing well enough? So let's move to NVIDIA. We are getting earnings next week. Do we see margins in the mid-70s like we've been promised?
I do think so. I do think that NVIDIA is going to be able to return. It did take a period of time. There were some costs in terms of calibrating for the Blackwell generation, but we've seen the ramp. Our channel checks suggest that the Blackwell numbers could be even a little bit better. And this has helped, like it did in the last quarter, to offset for some of the challenges and the uncertainty around China. That China play and that put has continued to be the uncertainty. I will say this, though. If NVIDIA stumbles in any way, even just a little bit, that actually could be what creates a bit of a break in the market. We saw the rally today behind Powell's, dovish sentiment. But I think the whole market basically comes into this expecting NVIDIA to not only perform, but outperform, to show good guidance and show some confidence in the outcomes that will come in China.
Absolutely, and we keep getting sort of conflicting reports, and maybe it depends on what's going on in China, but that, you know, things are fine, and the US is allowing NVIDIA make, you know, maybe less productive chips for China, and then suddenly China doesn't want them and so on. So maybe we'll get some clarity on the call at least. But just in terms of NVIDIA's own numbers on the inside, has any of this been a distraction for it, or can it continue to build out its other client base?
Yeah, I think the demand, and we've got the chip market sized, and this is palpable, and it's going to continue beyond China for a number of years ahead. You know, we see a double-digit CAGR that will go all the way to the end of the decade for this GPU market, and NVIDIA is expected to keep in the 90s%. So that's even as we continue to extend, and as AMD comes into market, as Broadcom and these homegrown chips grow, you're going to see continued dominance from NVIDIA. I do think the China thing's a bit of a distraction, and I'll quickly add, I think China really needs NVIDIA chips, and they will for the foreseeable future. I think it's a mistake to underestimate China's resolve and what it's doing with Huawei and its interest in potentially being able to build its own chips. But the reason they want those deprecated 4-year-old H20s is because there are researchers and developers that are building AI in China want to build on NVIDIA.
Amazing. Dan, thank you so much, as always, for your thoughts. Futurum CEO Dan Newman joining us there. Well, let's take a look at some notable movers in after-hours trading. We're seeing massive declines for Wayfair and RH. This after the Trump administration and President Trump himself actually truthed out that he was starting a tariff probe into furniture imports. And of course, that would very negatively affect those stocks which are already, suffering under the weight of tariffs and so on. Although Wayfair has had a great run this year, it's up more than 70% year to date. And then I do want to also mention this headline that's just crossing the Bloomberg: Starbucks reducing a schedule at US coffee plants in order to curb costs. So Starbucks there also trying to curb costs like many other companies in this environment. This is The Close on Bloomberg. On the tariff front, President Trump announcing a tariff probe into furniture imports, saying he aims to complete the investigation within the next 50 days. Also saying the exact tariff rate is yet to be determined. We saw Wayfair and RH take a big leg lower on this news in after-hours trading. And of course, this all as Canada's Prime Minister Mark Carney says he's lifting some retaliatory tariffs on US products, obviously seeking to lower tensions with the White House. Joining us now to discuss all of this is James Lucier, founding partner at Capital Alpha Partners. So James, just on this most recent truth where the president says that he is going to investigate furniture imports, explain it to me. We're already looking at lumber tariffs. We're already looking at just regular tariffs on goods that, transition between countries and so on. Surely furniture imports are not a national security threat, are they?
Well, they have to be a national security threat to qualify for tariffs under Section 232. But what we're seeing with President Trump is literally a new tariff almost every day. Yesterday, the new tariff was on wind turbine components, so figure that out. And as you noted, we don't know what the rates are. It creates a tremendous amount of uncertainty for people in the marketplace because you've got all these new tariffs that come in and no one really knows how to gauge the impact, least of all Jay Powell. On Tuesday, we had to digest the news of 407 additional product lines for steel and aluminum products being subject to tariffs. And those are a lot of consumer products, everything from fire extinguishers to baby strollers. So people are really scratching their heads and wondering when this tariff nonsense is going to stop.
James, what are the odds the courts strike down, as you're calling it, his mega tariffs policy?
Yeah, that's something that investors should be looking for literally in the next week or so as we go into the Labor Day weekend. The Federal Circuit Court of Appeals has been considering this case on an accelerated basis. Two federal courts have already ruled that the tariffs are under IEEPA, which is a different law, not Section 232. The tariffs under IEEPA, according to two courts, are unlawful and unconstitutional. Now there's a big appeals court considering that question, and it's expected that they hand down the decision pretty soon. And they could be the third federal court in a row, 3 strikes. Calling these tariffs unconstitutional and unlawful, which means that the tariffs would have to be refunded if the court goes through with its order.
Yeah, I mean, that's so hard to imagine everybody, appealing and applying for a refund. Where would you even apply, for your refund to? But at the same time, if it's struck down, does the president have any other avenues? Can he go against the Supreme Court?
Well, he said that he'll take this all the way up to the Supreme Court. And it's important to note that just as President Trump has been tweeting about Fed governors, just as he's been tweeting about Jay Powell, he is also tweeting about the courts and talking about how the courts will cause a financial catastrophe on the order of a Great Depression if they strike his tariffs down. So just as he's been chasing Jay Powell via social media, I think we need to worry about President Trump going after the Supreme Court, haranguing them to provide a stay that would keep his tariffs in place in the event that this new court, the Federal Circuit Court of Appeals, strikes them down.
We'll know, as you say, in the next week, undoubtedly. Moving to Canada, did the Canadian Prime Minister just take a huge gamble by deciding that he wasn't going to tariff some of the USMCA compliant goods?
Well, I think he did. I mean, obviously, this is a very sensitive question in Canada. And I should say that I spent a fair amount of time in Canada myself. My father's family is Canadian. So I think the Canadians, like our friends in Europe, have been doing their best to offer Trump conciliatory gestures. But it just seems like nothing you do to make peace with Trump is ever going to satisfy him. So I give Mr. Carney props for this. And I hope that we can begin a process to lower the trade tensions between the U.S. and Canada. Certainly no one on the Canadian side wants to see this continuing.
You would worry, though, that you give an inch and a mile gets taken at some point. I mean, now that Canada has extended the olive branch, as it says on the graphic, what will the U.S. do except ask for more?
That's the big problem, and that's the reason why countries have invested so much goodwill in offering Trump trade deals, in going through negotiations, in offering big concessions, and not doing any retaliatory tariffs at all, even when we're hitting them with at least a 15% tariff in the case of EU, in the case of Japan, in the case of South Korea. We're hitting them with a tariff, and yet they are promising to buy American goods and to invest more in the United States. That's a big investment of goodwill, and I think the president needs to be careful not to squander that goodwill by not taking yes for an answer.
Very basic answers here, James, needed because we're out of time. But the chances that we'll have a satisfactory deal with China at some point, and the same for India?
Those are both very hard. In the case of India, I think that the IEEPA tariffs that the courts are going to rule on in the near future is going to be a big factor. I think that if the Federal Circuit Court of Appeals strikes down the IEEPA tariffs in the near future, it's going to complicate prospects for trade deals with both China and India.
All right, so sequence matters once again. James Lucier, thank you so much for joining us this Friday evening. James Lucier is founding partner at Capital Alpha Partners. Still ahead, what investors need to watch out for next week. This is Bloomberg. Netflix is hoping to make history this weekend, not on its streaming platform, but at the cinema. Bloomberg's entertainment reporter Chris Palmeri joins us. We're watching some pictures here, Chris, so explain to us what we are watching exactly.
It's just about the hottest animated musical film in the world right now, K-pop Demon Hunters. It was released 2 months ago on Netflix. Very unusual move this weekend, 2 days only. They're putting in theaters. You know, Netflix likes to focus on its streaming customers and ignores, for most of its films, the box office, but it's making an exception this weekend.
It looks fascinating. Are there any American voices being used, for example, or is it completely a Korean cast?
Well, that's the surprising thing about it is an American-made K-pop film. When I first heard about it, I was anticipating, you know, something with dubbing and that. It was made by Korean Canadians for Sony, a Japanese company, and they sold it to Netflix. But in spite of all that multiculturalism, it's very popular in South Korea. The music is very catchy. It's topping the charts, Billboard and on streaming, Spotify and that. And so it's just one of these global phenomena.
And correct me if I'm wrong, but Netflix does seem to do international extraordinarily well. They had big hits internationally around COVID and post-COVID too, right?
I mean, that's the thing. They can take something globally without the big promotion. I mean, why most movie studios release stuff in theaters is because they have all that buildup, all that marketing, and then obviously they can make money off it. Netflix is just like, we're taking it everybody all around the world at once, and that's their model, and it's working in this case too.
And I love how they shove everything together. So everything that seems to be working right now. So K-pop, you know, the idea that you need to be hunting demons or some kind of ghoul or zombie or whatever. But also a musical, like they're literally just saying, okay, this box.
And a competition show, that's what it is. It's a fictional K-pop female band versus a boy band. And so, yeah, it's got all of these elements that are, you know, pop culture at the moment. And, you know, they could have easily screwed it up, but the people who made it really tapped into the authenticity of Korean families and culture, and that's what's part of what made it so successful.
So if we're, you know, all watched up on our K-pop Demon Hunters, Chris, what else is on at the cinema this weekend?
Well, it looks like it's going to displace Weapons. It's a slow weekend. That's a horror movie from Warner Brothers, and that's in its third week. So, you know, we're seeing the sort of summer doldrums, and that's why they're doing this in part, and why it's going to do so well.
Can't wait to see the numbers on Monday and Tuesday. Thank you to you. That is Bloomberg Entertainment reporter Chris Palmeri there joining us. So we have another week in August next week. Let's look ahead to what else we're watching over the next week, because there is going to be plenty to watch. South Korea's president, for example, visiting President Trump at the White House. We'll get comments as well from Federal Reserve officials John Williams and Laurie Logan. It will be fascinating to hear what they have to say after this market reaction. John Williams, of course, of the New York Fed, and keeps an eye on markets very closely. Tuesday, U.S. durable goods conference boards, consumer sentiment data, which will be really important to start watching now in terms of inflation expectations. Wednesday, of course, the big one, Nvidia earnings. We're all going to be on that call post the market close. And U.S. tariffs on India are set to double on Wednesday as well, don't forget, to 50%. Thursday, more Fed speak, this time from Governor Chris Waller, and another read on the US labour market with more jobless claims. And then Friday, another big one, we get inflation data. US PCE data comes to us on Friday, and of course those de minimis exemptions come to an end. Let's take a look at some notable movers in after-hours trading, and we have to concentrate on Wayfair and RH. Down more than 7% apiece after the president truthed out that he was starting an investigation into furniture imports. Now, these companies had been doing well year to date, but again, not taking to that announcement too well. That does it for us. Balance of Power is up next. Do have a great evening. This is Bloomberg.